let's bring in Martin Crabb from Shaw and Partners live with us here in Barangaroo. Martin, good to see you.
Good to see you too.
Okay, so let's talk bingo. I mean, that really hit the nail on the head today, didn't it? And we'll talk company specifics, but what do you think this tells us about the broader environment? We were expecting M&A to come through in 2021.
Yeah, private equity, the late entrant to the party. So, so the CD consortium, which is the old Champ Private Equity and Friends, lobbed that $3.50 bid, which is well above most people's expectations of what the company was worth. It's a staggering 60 times next 12 months earnings. So they're obviously looking at the investment that the company's made longer term and the fruition that that's going to bring in maybe 3 years' time, maybe 5 years' time. So they're taking a long view. So everyone's gone and looked at, well, okay, private equity, why are they paying these sorts of multiples? The multiples they've been paying for business have been creeping higher. There's a KPMG report, I think, or a Deloitte report that says the multiple that they're paying now on average is around about 15 times EV to EBITDA, which is a big number. So 10 years ago, that would have been 7 times. The whole thing was they would arbitrage the capital stack. They'd go and buy cheap companies. They'd fix them up or repair them and then flog them off. Here they seem to be buying companies at a premium almost, where they can see their capital and their network can add value. So there's $1.6 trillion in dry powder in current PE funds. So that's money that's already been raised but not committed. But if you talk to anyone in the PE space, they're getting knocks on their doors all the time from investors who want to allocate capital. Everyone's shifting out of low risk assets into high risk assets. Probably the highest risk asset you can buy is PE or venture capital. So there's people sort of moving up into that space because they can still see double digit returns. And so there's a lot of money chasing, not very many deals, hence the price.
Yeah, lots of money around as well. So when it comes to bingo, clearly the share price going gangbusters today, up by close to 20%. It's having a flow-on impact on Cleanaway. I mean, is bingo a good business if you're strategically an investor? Do you play bingo? Do you look elsewhere in the space?
Yeah, look, my understanding is that it's a friendly approach. So apparently they've been in discussions last year with the family that controls the company. And they're being invited into the consortium. So the deal itself is quite conditional, so we're not 100% sure the board's going to approve it. The board's, as they should do, appointed an independent panel to look at it. $3.50 cash with a potential scrip alternative. So if you want the capital gains tax rollover relief, you can take a scrip alternative. They haven't determined what that's going to look like, but it does seem to be a price at which you just walk away and you move on. It's a big multiple. The stock was sort of trading in the mid twos for a while. I think we had a high, maybe 270 valuation on it. So they're paying a significant premium to that. So in this market, you definitely want to, if you can, take the money off the table. Either wait for the 350 or just sell it, as many investors are. Is it trading around 330, 335 or something when I last looked? So there's a little bit of a discount for uncertainty, but there are some good opportunities out there to probably take some money off the table.
Yeah, preliminary settlement at $3.28. Look, up close to 20%, but it's not actually the best performer on the 200 today. Tyro, re-emerging from its trading hold. Yeah. Obviously some accusations from short sellers, service disruptions and the like. But share price up 26% today.
Not bad, is it? So these guys got attacked by a short seller, right? So and now they've rebuked it. So there's this yo-yo. Do you believe the short seller? Do you believe the company? Seek had a similar experience where they fell 10% on the day when it was trading halt, and they've subsequently gone up about 20 or 30%. But other companies like Quintus and Blue Sky, they never survived the short attack. So I wouldn't want to be a company that's being attacked by a short. It's just very stressful, right? Because they write a whole bunch of stuff, some of which is based on truth, but some of which is obviously elaborated, and then you have to go and rebut it, and who's the market going to believe? So bit of a tricky one for Tyro.
But Tyro does still, in relation to the failure of some of its terminals, I mean, it does have a reputation to rebuild in large part, if not with shareholders or investors, with its merchants, which really underpin the business as well.
Yeah.
I mean, this has not been a good story for them.
No, it's not. It's not good. I mean, if your terminals go down, I mean that's kind of what your business is. It's like a miner blowing up a 45,000-year-old cave. You're just not supposed to do it, right?
Yeah, I'd say Rio might be in a little bit more hot water over that one. It was interesting to hear some of the commentary coming from the company. Clearly they've been put on notice. But beyond that, smooth sailing in terms of iron ore, or was there a little bit more nuance in that iron ore read that you guys took out of
look,
it?
there's a couple of things in that. One, I mean, my colleague Peter O'Connor talks about the trust bucket being empty, and they've got to spend a lot of time filling it back up. There's no one trusts them. No one trusts the board, and obviously you've got a completely new MD who was not considered CEO material, so maybe analysts didn't get to know Jacob as well as they could have. So there's going to be a honeymoon period for him where he's got to go and establish credibility, but more importantly, the board. I mean, for some companies like Crown, the board's got a big target on itself. Maybe at Rio, some heads need to roll as well. But so there's that part of it, which is difficult to put, a numerical value or a dollar value on. What you can do is look at the iron ore business. So they guided a level of iron ore production that's pretty much the same level of iron ore they've been pumping out for. I think we look back 7 years. They've pretty much had constant, iron ore production for 7 years. You look at the other players in the market, BHP, Fortescue, ramped up production. Rio always talk about they've got the premium assets, they've got the premium product. They haven't managed to grow production. So as an investor in a mining company, apart from riding the commodity price cycle, you want production growth, right? You want companies that are developing mines, exploring, something like Oz Minerals, right, which has just massively increased its production profile. Because you know that even if the price of the commodity goes up and down, you've got this sort of underlying growth in production. Rio doesn't have that in its iron ore. So that's a real disappointment that it's been 7 years of no production growth. So there's that. There's also the fact that they got a discount on their iron ore. And again, if you listen to the company, best quality product, they should be getting a premium to the benchmark, but they're getting a discount. So I think that continues to disappoint the market.
Interesting. From one cyclical name to a sector which is dominated by cyclicals, financials. Seeing some big gains today. I know that Goldman Sachs, a couple of price target upgrades for the big four. I know UBS is also feeling pretty optimistic about Westpac in particular. For an upswing in a cyclical cycle at the start, there's a few places that would be worse positioned than they've been sitting in a bank at the moment. So you're still bullish?
Yeah, less so. If we go back to August, not that long ago, everyone hated the banks. Like, no one wanted to be there. There's no growth. The bad debts are going to knock them out. Their net interest margins in a low interest rate environment is just going to get crushed. And here we are, they're trading on almost 17 times earnings. It's been a massive re-rate. But it makes sense. If you think of all of the partial economic data that's come out since August, it's all much better than expected. Apart from what the previous speaker was talking about, credit cards being a little bit softer in December, you kind of got to expect that. Every other number's been great. Payrolls, housing starts, credit growth, all that sort of stuff. So what analysts have been doing is say, look, there's no Armageddon scenario here. The bad and doubtful debt expenses that they charged back in March and then reaffirmed a little bit in September, they're not going to be anything like that. It looks like ASIC is probably targeting other industries now, so they're not going to have too many more sort of royal inquiry-based sort of punitive damages. They've obviously spent the time to get their house in order. So you've got the regulatory costs fall away, the bad and doubtful debt expenses fall away, and you've got strong credit growth. And it doesn't look like bank interest margins are under as much pressure as people thought. So the things come upgrades. It's the most upgraded sector in the market, which is bizarre because it's like, you've got resources and industrials and mining services all tearing, yet the bank sector's the one that's most upgraded. And it's not necessarily because it's a wonderful place to be, it's just expectations were so beaten down that we're sort of coming back. It's starting to get pretty full. As I said, it's on 16.7 times earnings, which is a big multiple for banks, but the momentum's all there. So running in, through reporting season, most of them are March balances, so we won't get the numbers till April, May. So I think they're a pretty safe place to be. And the other thing, Scuddy, is dividends. APRA said you can't pay more than 50% of your profits in dividends. So they slashed the dividends, which caused a lot of people to sell the stock. So earnings will go up, dividends will go up, and payout ratios will go up. So there'd be a good place to buy for income, which is what everyone's going to chase this year.
Now, I was just going to ask a follow-up on Rio on dividends as well. We have some out there flagging potential special dividend, potential share buyback.
Yeah.
What are you and Peter sort of thinking on that front?
Yeah, I'm not sure with buybacks, it's difficult to forecast them.
Yeah.
You they're a nice surprise if you get them. I think it'll come probably down to its franking account balance. If they've got, and I haven't looked at it for a while to be honest, if they've got a nice fat franking account balance, they can do a selected buyback, and that's a very efficient use of capital, and it also delivers those franking credits to the people who can use them. So I wouldn't be surprised if they did that.
Okay, and just on the region, so we mentioned that the Australian market is going pretty well today. So are markets around the Asian region. We had a chat earlier with a gentleman, a fund manager from Hong Kong, who said, look, Asia's kind of the place to be this year. It's going to continue to roar.
Yeah, I mean, Hong Kong's up 3% today or something, right? So, I mean, last time I looked at the multiples, these markets are pretty cheap. I mean, yes, they've re-rated, but I think Hong Kong's on 13, 14 times earnings, and the rest of the world's on 20. Because it got beaten up not just by the whole trade crossfire, but also the political unrest that was happening in Hong Kong. So a lot of people last year said, look, this is all too hard. Yeah, it's not just the coronavirus we need to worry about and the trade war, we've got to worry about civil unrest. So let's just get out. And then the other thing is the big tech stocks, would have been banned from the NYSE. So, I mean, I think Tencent's up 16%, 17% this month alone, because people just fear that Biden, he may not be, dovish to China on day one, but he's going to be less, less aggressive towards China than maybe Trump was going to be. And things like kicking their stocks out of the market, probably that's not going to be something they do. So I think people in the region, or the ones I speak to anyway, are much more favourable about a Joe Biden presidency than a Donald Trump one. So I think there's a little bit of a re-rating going on there as well.
Yeah, I think that fund manager said, look, it couldn't get any worse than it was under Trump, so there you go.
I noticed Robert Lighthizer from the US Trade Representative was pleading with the Biden administration to go and keep the trade tariffs in place. Whether that actually lasts or not, we'll find out.
Yeah.
Okay, look, I think we've covered pretty much everything, but we have been doing a little bit of a poll with all of our guests just about the retailers. They've gone so well. Harvey Norman, up, I think, at the highest level since 2008 today. We've had a number of these upgrades coming ahead of reporting season from the retailers. Yeah. Does it still have a ways to run? Yeah,
look, it's always difficult to pick the top of these things. So I just look at the macro backdrop, Nadine, and I think you saw super retail upgrade. You saw JB Hi-Fi the other day come up 100% profit growth, and you look at how much cash has been built up in household savings accounts in the past 9 months, and it's $100 billion. It's massive. We typically only spend $160 billion a year on discretionary spending, and we spend $63 billion overseas on travel and travel-related expenses. So we're spending about $220 billion a year. We've got 100 in savings and 60 back from travel. So it's like a year's consumption. Now, not all of that money is going to be applied to discretionary spending. Some of it will be to pay down debt and things like that, to invest. But it's just a really good setup for retailers. I think there's a point at which everyone's it's like the pantry-demic. Everyone's restocked the stuff they wanted, whether it was a new PlayStation for the kids or a new TV or a new set of golf clubs or whatever. People will go through that process and then they'll get to the point where, well, okay, I don't need to buy any more stuff. I'm done. I'll go and find other ways to spend the money. But I don't think we're there yet. I think this year looks really good for domestic retail. The domestic economy in general, I mean, housing looks fantastic. Yeah. We could get 300,000 housing starts this year, which is amazing. That's never happened before. Which
Heath Moss from HLM today was telling us, think about those houses and those new homes. Yeah. Don't people have to go out and buy things for their new homes?
Absolutely.
So,
Absolutely.
Some people are finding out about that more readily than others.
Yeah. All right, Martin Crabb, I hope you've made your way through your pandemic shopping now. I know you still had some tins of tomatoes and rice left even late last year.
Still working through it.
All right. Look, great to have you in. We'll see you next week.
Great.